All right, let's get right into it. We're going to try and make sense of one of the biggest puzzles in the financial world right now, what I'm calling the Great Gold Paradox. It's a mystery that has stumped some of the smartest people out there, and today we're going to unpack it piece by piece. So just think about this for a second. We're living in a world that feels like it's getting more chaotic by the day. We have wars, the threat of inflation is on everyone's mind, and government debt is just out of control. In that kind of world, gold is supposed to be your ultimate safe haven, right? It's the insurance policy. And yet, it's in a total freefall. How does that make any sense? I mean, just look at this list. It's like a textbook case for why you should own gold. Geopolitical risk? You bet. The fear that our money's going to be worth less tomorrow? Oh yeah. Governments printing money like there's no tomorrow? Check and double check. Any one of these things should be like a rocket booster for the price of gold. All of them together, and yet, here we are.
Okay, so the first thing you have to ask is this the market trying to tell us something? Is this huge drop in the price of gold actually a signal about what's coming next for the global economy?
So, the number one theory out there, the one you'll hear from most people, is that gold is sniffing out a big policy change. The idea is simple. Central banks are finally getting serious about inflation, and they're about to start hiking interest rates aggressively. And when rates go up, boring old gold, which pays you nothing to hold it, starts to look a lot less attractive.
And if you go and look at the futures market, it seems to confirm this whole story. Traders are placing bets right now on multiple interest rate hikes over the next few years. So the market seems convinced. But is that really what's happening? Is that the whole story?
Well, this is where that whole idea starts to fall apart. Because when you really look at the situation, you realize this whole notion of central banks being able to aggressively tighten monetary policy, it's pretty much an illusion. They're actually caught in a trap. You see, they put on a good show. They want everyone to believe they're in control, that they have the tools to fight inflation, that they can just raise rates whenever they want. But the hard, cold economic and political reality is they can't, not in any meaningful way. They've been backed into a corner. And these are the walls of that trap. I mean, first, you've got basic economics. You just don't jack up interest rates in the middle of a supply shock. It makes things worse. Then you look around, and you see that Europe's economy is already looking shaky. And even the US job market is starting to cool off. But the biggest wall, the one they absolutely cannot climb over, is that last one.
Just look at that number, $40 trillion. When you're dealing with a debt that massive, the whole debate about a quarter-point rate hike here or there is almost a sideshow. The government simply cannot afford to pay significantly higher interest on that debt. The interest payments alone would absolutely cripple the budget. It is that simple.
So what does that mean? It means they really only have one move left. They have to keep the system flush with cash. They have to keep creating liquidity. Why? To slowly devalue the currency, which makes that giant pile of debt a little bit easier to manage. This isn't some newfangled idea, by the way. The Romans were doing this 2,000 years ago, shaving the hedges off their coins. It's called monetary degradation, and in the long run, it's about the most bullish thing you can imagine for an asset like gold. So, if we can agree that the drop in gold probably isn't about some fantasy of future rate hikes and that the long-term case for gold is actually stronger than ever, then we have to ask a totally different question.
Exactly. Who is it? Who would be selling their ultimate insurance policy at the exact moment the hurricane is making landfall? And not just selling, but dumping it on the market so aggressively that they're crashing the price. It makes no sense. Who would do that?
And then you see this. And everything clicks into place. This is the smoking gun. The massive gold sell-off started on the very same day, almost down to the minute, that military strikes began in Iran and the price of oil went through the roof. This is not a coincidence. These events are absolutely connected.
And the way the selling is happening tells you everything you need to know. Think about a typical central bank, a strategic player. They move in secret. They're patient. The last thing they want to do is crash the price of an asset they own. But this seller, they're the complete opposite. Open, aggressive, desperate. This isn't the profile of a chess player. This is the profile of someone who's in trouble and needs cash now.
So the answer becomes pretty clear. The sellers are the Gulf nations and their massive sovereign wealth funds. The shock of the conflict, the explosion in energy prices, it's created a sudden, massive, and desperate need for US dollars. They need liquidity to stabilize things, and they're being forced to sell their best, most liquid asset to get it, physical gold. When you're in a panic, you don't care about the price. You just need the cash.
Okay, so let's zoom out. What's the big takeaway here? This isn't just some weird story about the price of gold. No, this is a clue, a symptom of a much, much bigger game that's playing out across the globe.
You see, this crisis in the Middle East, as big as it is, it's just one battle in a much larger strategic conflict between the United States and China for global dominance. A key goal for the U.S. is to control the world's energy supply, because if you control energy, you have a huge lever to pull on an energy-dependent manufacturing powerhouse like China. This forced selling of gold by the Gulf states, it's a direct consequence, a ripple effect of this giant geopolitical chess match.
And that, right there, is the most important question to leave you with. We've explained the paradox. The plunge in gold isn't a fundamental statement on its value, it's the result of a temporary liquidity squeeze. But what happens when that temporary selling pressure goes away? Well, the $40 trillion in debt is still there. The inevitable need to devalue the currency is still there. In fact, all the real reasons to own gold won't have just gone away. They'll be stronger than ever. And that is the real story to keep your eye on.